Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. The next 25 minutes we'll try and talk about one key aspect of mutual funds, especially in the current market scenario. Now that the markets have shown a rally over the last 1 year, over the last 2 years, over the last 4 years as well, since COVID lows, is it time to take stock of your portfolios, reevaluate your portfolio, take a fresh guard, and try and think about what your portfolio should look like? Within that aspect, I think a very important thing to consider, now that people are sitting on some bit of gains, is whether there are too many funds in the portfolio. So the question that we asked to both our experts is twofold. One, if one is to reevaluate the portfolio completely from the top, how does one do that? What are the things to keep in mind, and what should be the right set of funds in the portfolio? Two, how many funds are too many? Because a lot of you would be guilty, and I use the term carefully, would be guilty of subscribing to a bunch of thematic funds, NFOs, whatever is in vogue, and by the time you look at your mutual fund portfolio, it looks like it's got too many funds and you don't know what to delete. And therefore, I think it's important to take some advice on that. Kshitij Mahajan, Managing Partner and CEO, Complete Circle Wealth Solutions, and Prableen Bajpai, founder of FinFix Research and Analytics. Both of you, thank you so much. It's great to be talking to you after a while. Prableen, let's start with you, ladies first, of course. And how do you think of a reevaluation of the portfolio, taking a fresh guard of sorts, now that most mutual funds or most mutual fund unit holders would be sitting on gains? There would be very few who would be sitting on losses, really. So how to reevaluate as we hit the festive season and think of newer times?
Good afternoon, Neeraj, and hi, Kshitij. Great to be with both of you today on the show. Absolutely, I think you use the term guilty, and I've come across portfolios which have had schemes, about 92 of them. The second highest was around 88, followed by 59. So that's my top three, which I've analyzed. And Neeraj, I think it is a great time to actually go back and review. Ideally, it is an exercise which needs to be done annually so that you're never off track. But because we are actually all seeing returns which are spectacular across categories and themes. So I think it's a great time. And how investors can begin is that you have to have an Excel sheet. You'll have to sit down and look at your portfolio. Start with clubbing them within a category. So, for example, large cap, how many do you have? Mid caps, how many do you have? So you have to sort of put them under these sections. Then look at whether all of the large caps, let's say, are actively managed. Within mid caps, what do you have within the flexi caps? Looking at the overlap becomes really important, because a lot of large caps, for example, it's the top 100 stocks after all, which would be there in the portfolio. There will be overlaps. There will be overlaps in terms of the strategy which is followed. Mirai, Axis, PGIM, they follow growth style. So the kind of holdings which they'll have or the movement of their schemes has been pretty similar, for example, when value was performing. So you start clubbing them within categories, and then maybe you work out the percentage allocation and start looking at what has not beaten the benchmark and its peers. So you have the percentage allocation scheme wise. For example, if you have, I'll just name a fund. Let's say if you have a Franklin Prima in the mid cap, see if you're holding 2% of it in your overall portfolio, 5%, 10%, because that's really important, Neeraj, also to see what will be the tax implication. Then look at the performance compared with the peers and benchmark, and then take a call. But I think start decluttering with the smallest holdings from your portfolio. That's the simplest way to go.
Okay. Kshitij, opening thoughts from you on the same.
Opening thoughts is hello to both of you, and I think very well put by Prableen, how one should look at it. My sense is everything is looking too good. Portfolios are looking too good. You have balanced advantage fund at 18% compounding, little scary, but all I'm saying is stick to your asset allocation. First point should be, one should look at what asset allocation you have decided initially when you started the portfolio, because maybe good markets are not making it feel, but your risk appetite or risk capability remain the same. It is just that because everything looks good, you are okay to have this type of allocation towards your equity allocation. But go back, it's time to go back to your blackboard and draw the same concept again that let's say you have 75-25. If deviation is more than 5%, I think you should look at rebalancing it. Let's say if you have some funds flow coming your way, then you should look at parking the excess fund, which is or the new fund which is coming towards the fixed income side. Because in this market, I'm sure nobody is heavy on the fixed income side. The people who are investing with the asset allocation in mind, they must be heavy on the equity side only. The first thing is one should look at that. Second is when you review a portfolio, obviously one thing which everybody reviews is the past performance, but what is important is how that portfolio is positioned for the future, scenario. So one should look at that. And in fact, I share some data points here that what we look at is we go level 2, where we drill down on price to earning at portfolio level, EPS on the portfolio level. I think total return is another factor or parameter which one can look at, which give you for any specific period point to point annualized return. So that's another parameter which one should use. And at the same time, look at whether you are in a cyclical any allocation or anything which is very small where you're allocating. You should actually exit that allocation and consolidate your portfolio. So in mutual fund, we say that less is more, because sometimes in view of diversifying your portfolio, you over diversify. Let's say somebody is having 14, 15 funds in the portfolio, and then you have overlap of let's say 10-20% across portfolios. You end up buying the entire BSE 500. So the idea of 4-5 funds is to diversify, and that's how at max 5 funds is. Or maybe if you have a tax saver or let's say sectoral bet you want to play, 6 fund is more than enough. So I think once you stick to that and hold less number of funds in their portfolio.
Kshitij, a follow-up to you there. I heard you mention that before people know it, the funds in the portfolio are probably very high. So here's my basic question first, and then I'll come to the nature of the funds that could be there if you are taking a fresh guard for yourself. But how many funds is too much? Let's define a number. I mean, do you believe that if people have over 10 funds, let's say, and those 10 may have an ideal mix, which we will come to, but if people have over 10 funds or over 12 funds, is that over diversification, or is it over 15 funds, or is it over 20 funds?
Neeraj, interestingly, whenever we should analyze all this situation, we should not take last 4 days into account, because everything was running up. So, it looks like that if you have 25 funds also, still your portfolio is yielding a good return because you are diversifying and every fund has done well. But at the same time, my sense is anything which is more than 12, 13 is really very high. And at that time, it doesn't look like that in a year or 2 years' time, it doesn't affect the overall portfolio return. But eventually, in the long run, you see that to some extent, you're not even beating Nifty or let's say BSE 500. So that happens with fund. That's happened with stock with 30 plus stocks also, because we keep on reviewing a lot of clients' portfolio, and we normally come across that wherever the number of stock funds which are on a higher side over a longer period of time, and we here keep on talking about investing for a longer period of time, not for 1 to 5 years. So I think their the impact is much more vis-a-vis if you look at 1 or 2 year or 5 years time. So I think anything which is more than 12, 13 funds is actually on a higher side, very high side, which can be avoided to my senses. Yes, if you have allocation towards balanced advantage fund category or arbitrage fund category, you can't count that into your equity allocation because that's a balanced category. But yes, pure equity allocation, anything which is sector, momentum, value, growth, whatever contrarian, whatever play you want to have, or let's say small, large, mid, multi-cap, flexi-cap, that I'm talking about should not be more, which is something more than 12 will be very high.
Okay, Prableen, is that your number 2? It could be materially different, by the way. Your argument could be materially different, but what's the sweet number?
I wish there was a magic number here, Neeraj.
Still,
I think
average.
it so depends on. I'll go with a range of somewhere between 4 to 12. 4 for a beginner, because when you're starting off with your journey, let's say you may have 2 equity funds, and depending on your goals, you may have 1 debt fund. A combination of these, so you're looking to capture all the 3 asset classes. You're wanting some exposure, let's say to gold, you want equity, and you want debt. as well. So I feel one gold, one debt, and probably two equity to begin with. And as you grow and the portfolio size increases, I think it can go up to around 12 because within equity, probably somewhere between 7 to 8, followed with debt and gold international exposure. So this is the kind of range I think it's good if you're moving in. And if it's beyond that, then definitely, the reviews, I think that can do the trick here. An annual review is so underrated, Neeraj, because, that is the time when you go back and actually check how have you aligned and, which scheme is meant for which goal. And if you're doing that process, I don't think that you'll actually exceed the number of schemes that you initially thought of. And of course, the markets keep changing. There are so many NFOs which get launched. There are new themes, there are new styles which keep coming. So there is a temptation to invest, and there is no harm in addition. So while we are adding, what we also need to focus on is an exit. So the exit strategy becomes equally important so that, broadly that average number in your portfolio is maintained.
Noted. Okay. So Prableen, now let's try and narrow this down even further. People who have heard the two of you, let's say they agree. There's an investor who's watching you. She agrees that let me try and stick between, let's say she's not a starter. So she's saying, okay, I'll go between 8 to 12 funds. Now she wants to know from both of you, what should be the broad categorization of these 12 funds? The assumptions that I'm putting out, Prableen, is that the person, she's reviewing her portfolio. She's between 30 and 40 years of age. She's got moderate risk appetite, and she's got moderate earning capability, which will rise over a period of time. So I'm laying out the deductions because that would probably be the average viewer that we have, let's say. So now, that average viewer wants to know from you, Prableen, in those 10 funds that she should have in her schemes, in her portfolio, what should be the split between pure equity funds, hybrid funds, debt funds, small cap, mid cap, etc., and maybe thematics? What would you recommend?
So within equity, Neeraj, I'll go with a large cap and a mid cap passive. So a large cap Nifty 50, mid cap index fund. I will add a multi cap fund, a small cap fund. Broadly, that can be the equity exposure. And if you're looking to, add another kind of a strategy to your portfolio, momentum can be looked at, but again, an index fund. So this makes it 3 equity index funds and 2 actively managed equity funds. I'll also include international fund in the equity part because it is exposure to equities. So I'll go with 1 global fund. So that will make it about 6 funds, 1 gold, and probably, 2 debt funds. 1 can be, or an arbitrage, so the liquid and the arbitrage can be used depending on your tax slab and everything. So 1 arbitrage or liquid for your contingency fund, another debt fund maybe for a near-term requirement. And if there is another near-term goal, then a hybrid can be added. So I think that can be broadly the portfolio for a lady who's in between 30 to 40.
Okay, so a hybrid fund for goals, an arbitrage fund for liquidity, a debt fund if you have another liquid event around you,
Yes.
5 equity funds, 3 of which are index funds and 2 are actively managed funds. Probably I would presume that the actively managed funds form the mid cap and the small cap fund that you spoke about?
No, it's 1 multi-cap and 1 small cap.
One
so I've
multi-cap
taken a
and one
passive
small
for the
cap.
mid-cap as well.
Okay, so 1 multi-cap and 1 small cap are actively managed. The rest can be index funds. Broad summary of, and maybe I heard you mention about a thematic fund as well, possibility to add the alpha or the beta. Right? What do we call it?
The momentum strategy.
The momentum
That's a passive strategy. There's Nifty 200, 30 index that can be added.
Okay, well, that's a good divvy up, and I hope this helps you. Kshitij, what would your breakup be for the 12 funds that you said should be the max in the portfolio, or maybe 10, what have you?
Broadly, it's in line with what Praveen is saying, but I will have, because her risk appetite is moderate, as you said initially, let's say, so I think I will have 1 multi-cap, 1 flexi-cap, 1 large and mid-cap, and through larger mid and through your multi-cap fund, she'll have exposure to both small, mid, and large cap, all 3 categories. 1 can be, a smart beta index fund, and 1 can be a pure index fund, because as I see that, index fund on the banking side can be one one play which she can take. She's young, 30, 35 years of age, and eventually she's going to step up, her earnings also. So this is on the equity side. 5 funds, as I said, pure equity funds is what she can look at. 2 index, 3 active. In index also, 1 smart beta and 1 maybe a bank nifty she can look at, and then she can look at 1 arbitrage fund for contingency needs, or maybe emergency needs. She should do a SIP in that fund also, which can be liquidated as and when, if anything for emergency purpose she needs, she can do that. On the fixed income side, I would like to add a GSEC fund, and for her short-term goals, let's say for 2 to 3 years goals, I would like to have a balanced advantage fund. So overall, you can say a mix of 9 funds is what, or 8 funds is what can do the needful. GSEC, because we are expecting a rate cut further, although without rate cut, there's a rally of 50 bips on the 10-year side. But yes, we are expecting a rate cut. And there are some special situation funds on the fixed income side also, where there is a recovery of some assets which were lying dead, and then NCLT has a role play. So, these type of opportunities keep on coming in mutual fund also. So I think then 1 fixed income, 1 arbitrage, and 1 balanced advantage fund for 2 to 3 years goals.
Okay. So this helps for sure. Okay, both of you, thank you. This is beautiful because it kind of sums up what the portfolio should be like. Now, viewers, if you have specific queries, usually we tell them to even give the names of the funds, but there's too many funds to name. But ideally, if you're not quite sure of all of this, then maybe you should have a financial advisor as well. But if you have a financial advisor, and if the financial advisor is telling you about the quantum of schemes, etc., do try and show this show to the financial advisor and argue with your financial advisor about what is right and what is wrong. Don't just accept what is said just like that, but try and have a financial advisor if you're not 100% sure of all the things. Both of you, I'm not going to ask you about specific funds this time around, simply because it will become too long a show. But I have a few queries that have come in from guests, and I would love from our viewers, and I would love to know what you have to say to some of these, where it'll be great if you can maybe give some specific recommendations too. The first one is from Abhishek. Abhishek is aged 32 years. Abhishek is planning to start a long-term investment with 20,000 rupees per month SIP and a 20-year time horizon. Could you suggest some funds, because Abhishek is new to mutual funds and planning to start a longer-term investment horizon? Prableen, can I start with you on this?
Right. So his portfolio can start with, you want me to tell the names, right, Neeraj?
Yes, please. However you want to advise, yes.
Yeah. So it can be a equal weight strategy. He can take the Nifty 50 equal weight strategy, followed by an ICICI Mid Cap 150 fund and a multi-cap fund from Nippon or Kotak. A small cap fund can be an HDFC small cap, a Tata small cap. I think that can be good to start with. If he can take a slightly higher risk and eventually, maybe not right in the beginning, but eventually, like I mentioned, maybe a momentum strategy can be added. That can be from Motilal. Many other fund houses have it. That's the nice part of index funds, that you can choose any credible fund house. So that can be a broadly 5 scheme portfolio on the equity side. And I would definitely urge Abhishek to have an SIP in an arbitrage fund or a liquid fund to ensure that he has a contingency fund. And if he's doing a 20,000 SIP, let's say for 20 years, Neeraj, he can actually create a portfolio of about 2 crores. But after 20 years, that will be equivalent to about 60 to 63 lakhs of today. So it's important to step up. So if he's doing a 10% step up, he can create around 4 crores. So as his income increases, he should definitely increase his SIPs and keep continuing during downturns. Do not stop your SIPs. Do not chase returns.
Okay. So that's the first thing. Kshitij, you want to give a response to this as well? It's a great question for multiple people. 20-year time horizon, 20,000 rupees SIP. How do you split it up?
So I'm actually overwhelmed, and it's like music to ears that people are talking about 20-year investing. So that's the first good thing, and I think I should congratulate you, Neeraj, and many of your colleagues across who are working a lot. And we've all been talking to all these clients on various shows that you should go long and invest for long. I think that is something which creates wealth for clients. And I probably mentioned, must have taken 12% into account at a wealth of 2 crore over 20 years. But yes, you have to take this monster inflation into account, and then you have to step up your SIP. I think he's young, he has time on his side. He can have a mixed portfolio, like Praveen has said. I normally prefer, like for myself, that you have Franklin India Opportunity Fund, which is a good mix of value and growth. Then you have HSBC Multicap. Then you have HDFC Focus, which is a little heavy on banking sector, which has not done well for last 4.5 years. And we are expecting with rate cuts and NIM improving, banking stock should do well from here. And then there is a pure mid-cap Mere one can take, and Motilal large and mid-cap. So this is a portfolio he can look at. But at the same time, as your salary keeps on stepping up, you have some gains in your business coming on your way. So you should always step up your set, the type of wealth you can create. And if you can just continue for 5 more years, I don't know, like you're saying 20 years, maybe 25 years, then with step up, you can actually cross the magical number of 10, 11 crore also on your card. I think just keep on stepping up your participation by 8-10% every year, and you're very much there on a path of financial freedom.
Okay. By the way, he has, very quickly, he's got LIC MF Large and Mid Cap Fund Direct Growth and the Quantamental Fund Direct Growth plans already. Probably that's okay to keep, right? Or would you suggest a swap?
Quantamental will be a thematic fund, Neeraj. So it's okay if he's doing a very small SIP. What I'm seeing that it's 1,000 rupee SIP into both. Yeah, so probably he can just continue for now, but it's a thematic fund. So that's not something that we add on very initially. LIC large and mid cap can be continued, but what I suggested, there will be an overlap, I think, with LIC. So depending on what he chooses to finally pick in his portfolio, it would depend on that.
Got it. Okay. Query number 2, and we'll have to make it quick because we just have 2 more minutes left on the show. Ramesh, age 40 years. Ramesh asks, is the DSP Nifty Top 10 Equal Weight Fund a good choice of investment for an aggressive investor with a 5-year time horizon? Kshitij, any thoughts?
It's a very aggressive fund, although all top holdings are large cap only. But it works like a non-discretionary PMS, if you ask me, because 10 stocks and your performance will depend on 10 stocks only. So if you have the risk appetite, as I said, Neeraj, these markets have made most of the people and investors believe that they have a risk appetite and very high risk appetite. But my suggestion is, if you're looking at building a long-term portfolio and you really want to participate one of the fund which is on a high on risk, then you reduce overall allocation to 7 to 10% only in that fund, vis-a-vis your rest of the portfolio. So this can be a part of a client's portfolio, because all stocks are going to be large cap, but 10% across portfolio. I've seen it's ITC, LND, all the stocks are having 10% plus allocation in the strategy. So yes, but yes, reduce your overall allocation toward this type of fund.
Okay, 50 seconds. I'm taking one more query then. Mrinal, age 30 years, wants to start an SIP of 20,000 next 7-8 years. Single fund or opt for multiple funds? I think the answer is clear, Mrinal, but probably in 30-second answer, what would you say?
Can be split into 2 to 4 funds depending on the goals. Neeraj, a large cap index, a mid cap index, and a multi cap fund can be good to begin with if it's an all equity portfolio.
Got it. Okay, both of you, thank you so much for taking the time out and being with us on the Mutual Fund Show today. Really appreciate your time.
Thank you.
With that, it's a wrap. I hope you found it useful. Thanks so much for tuning in.